Welcome to the Best of U.S. Investors weekly review, and it's gonna be a doozy. Kerry's just evolving cheat sheet, how he is projecting where stock prices on companies are gonna go, and how he is using this cheat sheet and what he's learning every day, and he's applying and giving to you via the Platinum channel.
It's sort of like it's a domino effect. It's identifying what is the first domino that then is pushed into the second domino. And it's
Because
just a
again,
matter
you look at this and say the stock price was down 26%, or where was the one that was really ridiculous? Down 5%, but the earnings for that year were up 43%. Why was the stock price down? It was down because of that. Because the projected earnings and this price reflects not what it's worth today, but what it's going to be worth next week or next year.
I think this in combination with technical analysis is very key, because as we all know, the fundamentals can be spot on, but if the stock is trending south, it's trending south.
Well, a good example of that. On up here on my cheat sheet, no, that's on another page. I saw that Adobe was down. I went to my trading views, and Adobe is below the Fibonacci retracement level. Let me come off, and you put up Adobe, and and again, remember, based on this, Adobe is only going to give you a 12% return between now and the end of 2025.
You see that?
Look at how Adobe has come down. If you do a Fibonacci retracement from here to here, that's a weekly. Okay, you're going to find that it's crossed the Fibonacci 50% retracement.
So you're really, if you follow this, there is a lot of, you're saying that $490 or so, that is sort of that range. Anywhere between 550, 50% is
right there.
490.
That's a signal to buy.
Well, I think it's a combination of a signal to buy in combination with, because this is your 9, that white line's your 9. So every time it's hit that 9, it pulls back. So until you get, and I think that's where you have multiple indicators, and like Mark has taught in swing trading, you have a negative RSI, you have a RSI of 3170, you have a declining MACD, you have a declining slow stochastics. This, based on Fibonacci alone, this is in a zone where you probably want to start considering consuming, buying. But I would say you could be wrong in a big way. Because
and based
it's still trending down.
It isn't going to be a big winner in the next year and a half. It's got more downside.
Well, and I think that's where you bring these two fundamentals and technicals together. It's sort of like you have the fundamentals, it gives you the financial story, and then you come back and you confirm it with the technicals, and then you make your decisions based on that. Yeah, interesting.
Yeah,
very cool.
Let's pull up Apple now, since we were looking at that.
Oh, okay. I mean, Apple looks like Adobe.
Yeah.
It's, if you think about it, between what, 166 and 197, going back to May of 23, it's basically gone sideways. And so if you're like a long-term swing trading it, that would be one way to look at it. Yeah.
Well, I think, and again, I don't know if you read they have totally shut down their EV market, or their,
Yeah.
and they fired, I think, or laid off 600 people that were in that, and now they said they're going to go into robotics,
Yeah.
and they're
I
going to
guess
make humanoids.
it's a question. I watched a video the other day by Gary Cardone. Mark turned me on to this, and he was talking about, we were talking about Bitcoin and all that. And the guy was selling a $2 million home, and he said, and he said something that really struck me, and that was, what is the potential? How much further in price can this home go from where he bought it at 1.7 to now it's today's value at 2 million? How much further can that home go? You know, and chances are it's not going to go much higher, right? I mean, during the last 3 years, you've had a massive home purchasing, period of time. But when you get to over 2 million, there's not a lot of people who can afford that. And I wondered about that, and I asked, well, what about mature companies like Apple? How much higher can Apple go? Can it go over $200? Can it go to 300, 400, 500? Does it have the growth bandwidth, the product lineup to make it go higher? Or is it really, it's gone as far as it's going to go? And you buy it on the dips and you sell it on the peaks.
Well, I think you're right.
Kind of stock?
And if you look at the earnings growth on that Apple chart, there were times when they were growing at 68% the earnings per year, and now they're down to 9.
Yeah. You think about when you enter the Dow Jones Industrial Average, is that sort of the last leg?
Yeah.
That's the nursing home for mature stocks,
I think it is.
And I think that's where, if you're looking at this from the perspective of, I have to grow at a certain growth rate to achieve my financial goals, if it's retirement or whatever it is, you buying Apple, even though, I mean, you could probably, like you said, you can it's a more secure, established company, but are you going to get the return that you need out of it to achieve your the end result that you're trying to achieve, or end goal, if it's retirement or whatever? And that's where going down the market cap scale is something to take a look at.
Yeah.
Well, you look at Apple, like you said, the revenues are just down, quarter after quarter. But then again, how much of that buildup in their stock price was buying back their shares? Okay.
Yeah.
Borrowing and buying back their shares. And a lot of these tech companies do that. Well, at some point, you got to pay the piper, and piper is paid through revenue and net income, and they're not showing it anymore. So again, you can look at the charts. I mean, if you're a long-term investor, it looks like it's trading under the 200. So I would just stay out of it at that point from a long-term point of view until they could get back above the 200. But yeah, there's a lot of factors that factor into that. And again, you got to look at it in a way: are you swing trading it? Are you a long-term investor? Why are you in the stock? What reasons are you in it for? And when will you get out? What would force you to get out of it? And again, we're talking about what's the risk versus what's the reward based on your entry price. And I have a different view of it, that, I don't want to sit in an Apple stock that's dumped like that for the next 5 years until I hope it comes back to my cost basis price, because that's my lost opportunity cost. That money could be doing better in a treasury bill, for 5 years or however long they're good, or some other stock, or, some other asset class, as opposed to just sitting there and not making any money for me.
So today I was watching this video, this guy's financial advisor who was putting up on YouTube, and it was really good. It was really good. And he was talking about how the performance of the S&P 500 and the whole buy and hold strategy, and how, you got to look at this in maybe a more active way, which I commend the guy for actually saying active management in the financial planning industry. But he talked about the returns, and over time, the S&P 500 has gone up. But the one thing I have like a bone to pick about is that we don't ever talk about inflation and devaluation of the US dollar adjusted returns. We don't talk about that. We don't look at those returns. They don't say, XYZ stock did this, but with inflation and adjusted and deflating US dollar values, this is really the return. And so in this next section, we talk about buying power and the importance of understanding what buying power is and how you should maybe consider how you allocate going into the future. Because, if Apple goes up 26% in the next 2 years, what is inflation and devaluing US dollar effects on that growth? What is it really at?
Yep. Okay. Mortgage rates were down. As of last week, they dropped 2 basis points at 6.91%. Okay. However, borrowing costs are higher than the 6.4% a year earlier. So again, it's still higher than it was a year earlier, which is inflationary. Mortgage applications are down by 0.6%, ending last week, extending the 0.7% drop in the previous week to mark the third consecutive period of lower mortgage demand, further trimming the surge in applications in the start of the month, according to the data compiled by the MBA. Applications to refinance a home fell 2%, while those to purchase a home edged up 1% lower. So in some states, close to where Paul is, you can just move into a house if no one's living there. You don't have to worry about mortgage rates. That's what I'm hearing.
Squatters.
Hopefully that, yeah. So the interesting thing is, we still have what they say is a housing shortage. Okay. But the interest rates are still too high and, for people to move. And again, you're in a situation that if you have a house and you have a 3% interest rate and you want to sell and then get another mortgage, you're going to be at almost 7%, 8%, depending on your credit score, so people.
That's
don't
why
move.
house is not on the market.
Yeah. And the ones that are, you're seeing price reductions too. I've been seeing, especially down.
I just want to say to you, I just want to tell you that maybe housing, mortgage rates and houses, people like me are not selling their homes. I mean, I have a couple of homes. I'm not selling that home up north because there's no advantage to me to sell it, right? The government's going to tax me. So what advantage do baby boomers have to sell their homes to put more homes on the market? The government needs to turn around and say, hey, if you sell your house between this time and that time, we won't tax you on the capital gains. And I think then that would motivate us to do that, right? But otherwise, why should I sell it? Otherwise, I could rent it for great money. I can get, $6,000, $7,000 a month to rent my house up north. So why I can collect that money, and create an asset for that. But anyway, but I wanted to tell you was that what's come out in the last several weeks, which is really important to this subject, is that they're starting to be, and you're probably starting to see it down by you, Trent, is an overabundance of building for rentals. And we're becoming a rental nation now. Mm-hmm. So, and that's happening in many different states where there's more rentals available than there are renters. And those rental rates are coming down too.
In my area, the rent rates aren't coming down. It's, the typical house in my neighborhood's about 18 to 2,000 square feet, and the going rate is $4,000 a month, and people are signing the papers. They're going into a 1-year lease on them.
Right.
I think it depends on the area. Number one, because it is, in a lot of cases, it is cheaper to rent because you don't have some of the different maintenance elements of owning a home. So I think there is a younger generation that definitely is starting to look at, well, why would I want to own a home? You know, look at all the issues with owning a home. Plus, it's just so damn expensive.
Right. I don't think, back when I bought the house I'm sitting in or built it in 1999, I think my interest rate was close to 8%, but the cost of the house to build and the land was so much cheaper than it would be right now to do the same thing.
Mhm.
So,
Yeah,
know,
well,
to-
everything's
to-
relative.
yeah, but for me to sell this house and go buy an equivalent at another 6% interest rate, it's not equal to what I would have done, in 1999, because the house I have to buy is probably 4 times more expensive in the land than this one was at the time.
Yeah, for sure.
Yeah.
But that your greatest wealth is made in real estate,
Yeah.
or one of them, right?
Yeah.
Yep. And
That's what the
What's more-
millennials don't
what's-
understand.
that is true.
Well, it's also buying at the right time. My 23-year-old keeps sending
Agreed.
me pictures of homes in the area, and I'm like, that's a $500,000 home for 1,600 square feet. I know you want to get out of paying rent, but just wait. Just be patient.
Agreed.
Save your
Yeah.
down payment, get a 20% plus down payment, and then just wait until interest rates drop, keep your credit strong, have a relationship with a bank. And once you do see those rates go from 7% down to 5 or 4 or whatever they end up being, then you pounce on it, because at that point then there's blood in the streets at that point.
Or the market crashes too, and you get a better deal on that. That
Yeah.
$500,000 house is now
Exactly.
$250,000.
And I don't know, just in all y'all's areas, I don't know if you guys keep track of like home sales, but what I'm seeing is every week housing prices in my area are coming down. They're reducing
Same
the
in mine.
sales cost by 50, 100, and in some cases $200,000. Now, granted, you're still on average over $1 million for a place in the area I'm in, but it's not typical. But I suspect everybody else is seeing the same thing in some way.
I agree.
The place right across from me is on 20 acres, and it just sold, but it was on the market for over a year, which is amazing out here. But he had to accept, and he had to cut it by $250,000 to get it sold.
Oh my gosh.
And before that, there weren't that many for sale out there, and they would just go within a week, with multiple bids. And then I'm sitting in the middle of flyover country,
Yeah, I've got my neighbor just put their house back up on the market. They took it off for 2 months. It sat on the market for a year. And in 22, they would have sold it within 5 days. Now they're just struggling to get rid of it. And they won't. So
And I think these are these things we're talking about right now are the underlying items in our economy that don't get reflected in these reports, and
Exactly.
But you and I and everybody on this call see it every day, and like I said, we're going to talk a little bit about inflation here in a little bit and how it affects everything. But the other thing that I was going to say, Bob, is I found from Redfin that more than 1/3 of the homes in the U.S. were purchased with cash in February as mortgage rates remained high, according to a new report from Redfin. The median down payment for a house jumped to $55,600 in February, up 24.1% from February 2023. So up 24%.
Do you know why?
Well, home prices
Do you
are
know
up too.
why?
Go ahead.
So a lot of baby boomers are helping their millennial children with buying homes.
Huh.
And the wealthy millennials that have, they have some buck in their accounts, and they're handing them, $1 million to go out and get a house because they have too much money. And that's what's happening out there. They're transferring their wealth already. And that's how and where I live, where I have my place here in Ponte Vedra Beach, 50% of the homes are paid with cash.
Yep.
That's a high number.
That's what we saw here in our area during the whole, what, 2020 to 22 boom in housing over here. We saw, I believe, if I remember my numbers right, just over 50% of the homes were purchased with cash. And so
Yeah.
it was
And I'm not
very
talking,
rich people putting their money away
Yeah.
in a house.
But how many of
yeah,
those might be like?
I'm talking $1 million or more.
Yeah.
How many of those, Bob or Trent, do you think are BlackRock or companies buying these up?
In our
No, not where
area,
I am.
in our area, it's St. Joe. They're the largest landowner in northern part of Florida, and they are building communities that are rental communities because, you know, they see the benefit of that. They see the younger crowd wanting to get into a place, but they can't afford a $500,000+ house in the area, so they'll just rent it to them for $3,000 to $4,000, and they'll pay it.
Yeah,
So
but Trent, today, a $500,000 house is a starter home today. You know, back when I bought my first house in the 80s, my first house was $105,000.
mhm.
You know, that same house, when I sold it in 2004, I sold it for $500,000. That's how, you know,
Yeah,
wealth is built, right?
right, but I believe that your area that you're in Florida and where I'm at in Florida, these are unique areas, right?
I agree.
Whereas if you
I
go
agree.
into Alabama, where Kerry is in Birmingham, you can buy a house for $250,000, which is, I
I
would say,
agree.
the standard line. So you spread that out through the 50 states, and you probably are coming in between 2 and 400,000 as the medium household. Like that's where you're going to start. Florida's unique. I think that's, you know, we have to take that into account. And for like my daughter to live in this area and she wants to stay in this area, she's going to have to spend probably, you know, if she can get a housing crash and then have the money to and be able to finance it, she'll probably pick up a house around 300 or so. But in this environment, she can't touch anything for less than, you know, 450,000. And for a 23-year-old, I mean, she makes great income, but still, that's a shit ton of money.
Yeah.
You know, and I think that goes along with the whole, I think we're going to go down this rabbit hole, is buying power. So anyway,
You know, and again, we talked a little bit about this in purchasing power at the Platinum Zoom call.
we talked about it pretty extensively, Mark, I think.
What's that? Oh, yeah,
I think we talked about it pretty extensively.
Yeah, we pretty much made it the theme of the day.
Yeah.
Tell me
Hey,
what
Bob.
you mean, purchasing power. How are you relating that?
So the
Well-
other day, so I'll give you an example. Wednesday, Ginger and I left the studio. We had to go to the grocery store to get some things. And we got a pack of ground meat, 2 boxes of granola bars, and a handful of other things. And the bill was $75. Okay. We came back, or I was driving over here today or on Thursday, and Ginger calls me and we're talking, and she goes, by the way, what did we spend $75 on at the grocery store? I can't figure it out. And it really sort of hit me. And that was a year prior, the same items I would have bought would have probably cost about $55 to $65. So in a year, my purchasing power declined. And that's a relationship of inflation and the currency for which I bought those groceries with. My currency's weaker. The cost to manufacture those products has gone up. And so now my purchasing power has declined. And if you look at the historical viewpoint of purchasing power, we are constantly declining, which if you relate that to the stock market or retirement planning, that is one thing we never talked about as a financial advisor, in that true inflation is this, the power of my currency is this, and they keep widening. Is $500,000 in retirement savings going to be enough for the next 30 years of potential of life?
Well, exactly, because when you retire, you have, you plan for your retirement. I want whatever, let's say $1 million. And in our brain, we think $1 million, that's a lot of money. Well, $1 million is a lot more money 20 years ago than it is today.
Sure.
Okay. And just thinking 20 years what it's going to be worth. And so if you're 60 and you retire with $1 million in savings to draw out, plus your $2,000 a month in Social Security, and you decide that the 4% rule is going to get you $4,000 or whatever a month out of your retirement plus 2,000, so you're making $6,000 and you're doing okay until inflation comes in at 17% over the last 4 years, and then you've got the Treasury printing out more and more money through T-bills because our debt's going up $1 trillion every 3 months, and we're just paying for it with made-up money. So the value of your dollar over the last every year has been devalued by 10%. So now you're down 17% plus 10%, and you're only 3 years into it, and you can't afford your doctor's bills or your gas in your car anymore because you're on a fixed $6,000. Okay. And that's what's really going to eat you up. So when we started talking about when we're investing, we gotta invest to beat more than just inflation. We have to invest to beat, a devaluation of our currency. Otherwise, that $1 million by the time we get there is not going to be worth it, 5 years after you retire. So that's what we were talking about, purchasing power and looking at your accounts and your portfolios and how I don't have 5 years to wait around for Apple to come back, when you think about it in that term,
No.
No.
And Trent brought up a good point, and he dealt with it as an advisor. He brought up a good point that, 3 years after, one of his clients retired, they called back and said, "Hey, I need more money," And why did he need more money, Trent? Because prices went up.
Prices went up. Prescriptions were being
Yeah.
And the currency
written
was
handed out.
devalued. Yep.
Yeah.
And currency was devalued.
And then all of a sudden your
So-
retirement projections get, oh, you got enough money for the rest of your life. Well, sorry, you got enough money for the next 10 years. Maybe you should go back to work. And at that point you're 70 years old. So I think in here, and I'm just going to bring this back around to your cheat sheet. And that is when you're looking at these companies and you're looking out into the future. So I'm 55 or I'll be 55 soon. If I'm looking at 65 as my retirement goal, I have to fight a couple headwinds. One, what is what's the cost of inflation? Two, the cost of devaluing US dollar. And what am I going to, in what is the end goal? What am I going to need to achieve every year in a return to achieve those financial goals after the age of 65? Well, if I'm already losing 27% to devaluation and in inflation, I have to return a minimum of 36% return year after year based on today's numbers. So that means I have to change my asset allocation model and how I manage my money. Bringing that back to your cheat sheet, you have to identify companies who are going to have revenue growth, earnings per share growth, that's going to relate in stock price growth more than just an S&P 100-year average of 12%. If you're going to do this now, Mark had pointed out to me before we came off the gold standard in the early 70s, we probably didn't have this problem as much. But because we're off the gold standard, because now we have printing of money, we have 34 trillion in debt, and we're adding $1 trillion every 90 days or two. So is that the number, Mark?
Yep.
Yep. This has got to be factored into our long-term thinking and how we asset allocate and manage assets. I posted something on Instagram earlier this week, and I took the BlackRock 60/40 institutional mutual fund. So they mimic a 60/40 60% equities, 40% bonds, and it's a ETF or a mutual fund you can buy, and it just stays that route. Well, in the last 10 years, it's averaged 8%. What they don't factor in is the cost of a devaluing dollar and inflation. And in essence, you've actually lost money owning that asset class or that asset. And that really, my whole point of my Instagram post was, you have to start thinking differently when it comes to your asset allocation model. If you're holding bonds right now, you have been losing money. And the only thing that has really worked in the last year or so is really those 7 stocks. The S&P is the S&P, yes, the S&P's up, the Nasdaq's up, the Dow's up, great numbers, but factor in the cost of a deflating dollar and rising inflation costs. And I think that's where we as investors have to really start factoring more variables that affect the overall buying power that we will have today, but more importantly, down the road in the future.
So Robert is one of our tribe members of the Platinum Channel, and he is a business owner. I'll leave it at that because I don't have permission to talk more about what Robert does for a living. But he's a business owner. He employs people. He puts people to work. And in this section, he talks a bit about that, about where the state of manufacturing is, and along with, what do you believe when these job numbers come out and they say, oh yeah, we added 303,000 jobs. Granted, 72,000 of them were in the healthcare field and 71,000 were government jobs. What numbers should you be believing? And are these really good guidance to follow when it comes to investing and where the economy truly is?
There we go.
Mark, what I will say to you is that nobody from my warehouse or my machine shop walks in asking for a raise. Nobody. Because I put the word out. If you're looking for more money, there is no more money. You might as well just exit at that point.
Be
And not
grateful you
one
have a
has
job.
walked in. Yeah, exactly. That's the environment that we're in. Be grateful I didn't lay you off already. And I'm just keeping you on because you're good. And I'm willing to do that. But don't think that this is the time to come and ask for more money, because it's really not. Because it comes between the money and you, the money's coming first.
Yep.
Right.
I know it sounds harsh, but that's the way it is when you got to run a business.
Well, and to follow up, you're a great front man, Bob. The initial jobless claims, the number of people claiming unemployment benefits in the U.S. surged by 11,000 from the previous week's upwardly revised value to 221,000, the most in 2 months and well above the expectations of 214,000. The results pointed to a departure from the extended period of low initial claim counts and contrasted against other strong labor reports released this week, suggesting that the tightness in the U.S. labor market may be absorbing a delayed impact of elevated interest rates. So again,
Exactly.
another conflicting report. But
Yeah.
then you look at job quits. These are people that just quit. The number of job quits in the U.S. rose by 38,000 from the previous month, up from January's revised figures of 33.4 million and touching the highest in 3 months. So you got voluntary jobs quits, and this may be related to job openings because the number of job openings went up by 8,000 from the previous month to 8.7 million in February, above the market expectations of 8.75 million. So this is a confusing week to me to look at all these reports and say, they're not saying anything. They're saying they're contradicting each other. And again, you can contradict based on what you're looking at. I mean, if you look at a set of numbers and I look at a different set of numbers, we're going to come up with a different, result. But again, it's interesting to watch. Mortgage rates were down.
But you got to be able to read through the tea leaves, right? And
you do,
come up
if you
with
want
your
to take
own
the
assumption. Yeah.
Yep.
I don't
And again,
understand.
like
I don't understand the quit ratio, the quit number. Okay, you had what? How many was it that quit? 38,000 or something like that, or 11,000.
The number of job openings went up, or the job openings, it's job openings. So let me get back to quits. Number of job quits rose by 38,000 from the previous month to 3.48 million.
Does that count as I quit my job because I got a better job?
No,
Typically,
I
yeah.
quit my job. I quit my job on my own.
Right,
They
but
isn't-
typically when
look-
they quit, typically when they do that, they found another job.
Okay.
Right.
So really it's a
typically,
wash.
I'm not saying, you know, we're both right? I mean, at the end of the day, I think that you have a percentage of that has found another job. There's a percentage of that decide they want to start their own business, right? And they quit.
Yeah.
You know, that there's a mixed bag in that number.
The media is constantly talking about the Federal Reserve and the projection that they're going to cut rates this year. And in this next section, we get into why would you ever believe they're going to cut rates anytime soon? And actually, the conversation this week about from the different Federal Reserve chair, people out there, Federal Reserve reservists, I guess, or representatives, all are talking about possibly raising rates. So where's the media getting this idea that, hey, they're going to lower interest rates? And they quickly forget when you lower interest rates, it's because historically the economy is crashing.
When you look at what the Fed officials are saying, it sounds to me like they see inflation is rising in the future. That's what it looks like to me, because they're all saying kind of the same thing, kind of in a circular firing squad manner. But it doesn't sound to me like they're going to cut rates. And when you think about it, okay, why does everyone want the cut rates? The rates to be cut from a market standpoint, they think, well, then the market's going to rip. Well, hasn't the market been ripping since last October anyway? And, we have these rates. And another thing that Trent and I were talking about yesterday, we did a video, is when you look at over the history of our country, where we are in rates is about normal. 4 to 5% is about normal. So what's not normal is 0%. So I don't think that Powell has any interest in returning to the 0% interest rate. I think he wants to maintain it right around this point right now. But that's just my feeling. So what does this all mean? Go ahead, Bob.
No, that was me. Go ahead.
Oh, Trent, go ahead. So when we talk about it, Trent and I have had a long conversations in the last 2 weeks just about inflation and purchasing power and how we save and how do we actually make money, and are we making money? And then you look at Larry Fink. Okay, he did a letter to investors, and it was last week. We didn't have a meeting, so I didn't get to talk about it a little bit. But he talked about, and these are his words: in America, the situation is more urgent than I can ever remember. Since the start of the pandemic, the U.S. has issued roughly 11.1 trillion of new debt, and the amount is only part of the issue. There's also the interest rate of the Treasury that needs to pay for it, meaning that interest rates have gone up, and we all know that who have been in T-bills. 3 years ago, the rate on a 10-year Treasury bill was under 1%. But as I write this, it's over 4%, and that's a 3 percentage point increase. Is very dangerous. Should the current rates hold, it amounts to an extra $1 trillion of interest payments over the next decade. So why is this debt a problem now? Because historically, America's paid for old debt by issuing new debt in the form of Treasury securities. It's a workable strategy so long as people want to buy these securities. But going forward, the U.S. cannot take for granted that investors will want to buy them in such volume or at a premium they currently do. Today, around 30% of U.S. Treasury securities are held by foreign governments or investors. That percentage will likely go down as more countries build their own capital markets and invest domestically. And then the Congressional Budget Office came out and said they predict public debt could reach 166% of GDP by 2054, growing to an estimated 141.1 trillion from the current 34 trillion. Raising debt could also cause the US dollar to lose its status as the principal global reserve currency. And this is from the CBO. Then we had, let me see here. Then I was watching CNBC, and we talked a little bit on the Discord. And last week, you guys talked about it on the 3 o'clock, and we talked about it before about Bitcoin and its role in this. and they had Pompliano, who's a big Bitcoin guy. He was on CNBC, and he was talking about Bitcoin's 7 straight green months are likely to link investors becoming increasingly aware of inflation and the likelihood that it will remain hot as the Federal Reserve potentially moves to looser monetary policy. The Bitcoin bull also believes that some of the speculative froth surrounding Bitcoin and crypto markets may stem from the many people in the U.S. losing hope due to skyrocketing cost of living. The dollar has lost 25% of its purchasing power in 4 years. We have 1.1 trillion in credit card debt. We have 43 million Americans who have federal student debt. The average balance is $37,000. People have lost hope and they do not have hope. How are you supposed to live in a country where it's cheaper to rent than to buy a home in 50 major metros? That goes back to what we were talking about. I think that if you go and buy a lottery ticket, it's 300 million to 1 odds, he said. I think there are people right now who are saying, you know what? A meme coin has better odds than a lottery ticket. I think there's a lot of people that say Bitcoin is actually the safest bet. Then you look at Zimbabwe. Okay, this week Zimbabwe is expected to launch a new currency at its monetary policy meeting today, which will be backed by gold reserves as a part of its government's effort to mitigate the effect of the local currency's collapse. After a tour of the central bank vaults, President Mnangagwa said the Reserve Bank of Zimbabwe had enough gold to back the new currency. The current Zimbabwe dollar's value has plummeted more than 70% this year. Many Zimbabweans prefer to use the U.S. dollar given the instability of the local currency, and they largely choose to keep their money at home. And then going back to a little bit on Bitcoin, you look at what's happened. The U.S. listed Bitcoin exchange traded funds, and we've talked about this on the Discord, captured over $110 billion in trading volume, over $110 billion in trading volume in March, a figure 3 times higher than the volumes in January and February as the largest cryptocurrencies soared to record highs. Trading was led by BlackRock's IBIT, which comprised almost 50% of the total. Bloomberg intelligence analyst Eric Balkosnes said on X. Grayscale, GBTC was next with 20%, total shares followed by Fidelity's 17%. BlackRock's volumes have all originated from inflows since March 15th, data from Farsight Investor showed. It held over $16 billion worth of Bitcoin as of Tuesday's close. As previously reported, a large chunk of BlackRock's volume comes from retail investors with an average trading size of $13,000. So you talk about that and talk about inflation, and I'm seeing people move, and not only people, and individuals. Larry Fink, you've got Jamie Dimon, you've got a lot of big people around now talking about inflation and talking about how do I curb inflation, and a lot of them are investing in Bitcoin at this point. And really, when you talk about inflation, Trent brought this up, and I'm going to bring it up from California. Okay, so the government gets involved, raises the minimum wage to $20, presents significant challenges for thousands of restaurant operations across the state in the fast food industry. To cover the increased labor costs, many fast food restaurants have been forced to raise menu prices, inflation. However, this strategy has been met with resistance from consumers who find it increasingly difficult to afford their favorite fast food items due to the high prices. McDonald's, is one of the largest fast food chains, has been in the spotlight for notable price increases. For instance, the cost of a Big Mac combo meal, previously considered an affordable option, has surged to $18 in California. As a result, low-income customers are now cutting back on their fast food consumption, further exacerbating the challenges faced by these businesses. In response to the wage hikes, which went into effect Monday, fast food corporations like McDonald's, Popeyes, and Pizza Hut have resorted to laying off employees to mitigate the impact on their bottom line.
The whole buying power, the rising debt that the U.S. keeps tacking on, it's basically $1 trillion every 90 days is being added to our national debt. And honestly, there's really no way to pay this off. We are running in a period of time that could be so detrimental to investors, to retirement, to retirees, to future retirees, to the standard of living we are so used to in this country. And that is achievable. And it's blowing my mind the more I dig into this stuff. And understanding that for the last 4 years, we've averaged, I think, like 17% increase in true inflation. I ain't talking like CPI, which is 3.2 or something like that. That doesn't include everything like food or gasoline or health insurance or anything other than a handful of things like transportation, airfare, rent. I mean, rent's going up, housing is going up, the cost of money is continuously going up. So this whole idea that we're in a great economy, this BS that's coming out of Washington, come on. We as Americans have to start taking a stand and start looking at how are we going to combat this rising inflationary environment, this devaluing of our currency, US dollar, and the quickly lacking interest in buying our US debt. Adding 1.7 trillion to the budget, that we're going to need more, another 1.7 trillion, I think a 1.7 or 1.2, I don't know. You get the point. It's over $1 trillion. We're adding that on to the debt factor that we're not going to be able to pay it off, but the cost of servicing that debt is skyrocketing. Because a lot of that debt came on when Trump was in office, and now with Biden in office. I think it was like 11 trillion of the 34 trillion that came on between those two presidencies. Well, that cost of that debt was below 2%. Now that cost of that debt is over 4. And and how do you pay that? I mean, if you ran your household that way, and some people do, how do you cover a 25% interest rate on a credit card without just massively cutting back? Well, we're not cutting back in this country. And our leaders, our leadership that we continuously vote in is continuously taking us down this road. And this is what freaks my out, is that we're about to come into another election in November. And the two leading parties, the Democrats and the Republicans, it's basically same as usual. Is there independent? Yeah, there's Robert Kennedy Jr., but he ain't gonna win it. And if he did, you've got the Senate and the House are gonna fight his ass the whole way there. So how do we fix this? My answer to that question is, you gotta get in survival mode. You gotta get financially smart. And you gotta start questioning this whole it'll be okay. The S&P's gone up 12% on average over 100 years. Yeah, but inflation's 27. When you look at devaluation of the dollar at 10 and inflation over the last 4 years average of true inflation, let's be specific, is 17% a year. That means you got to be cranking out some major returns if you want a solid retirement down the road. And that means you got to change. You've got to change, and you got to start paying attention, and you got to start learning. And that's what Best of U.S. Investors is all about. So, you got questions? Shoot me a question at support@Best of U.S. Investors. If you want to get involved and join the Platinum channel and learn what we're seeing, it's $60 a month. Now we're offering 50% off for 3 months. You can get the coupon code below. But more importantly, take notice of where you stand in this whole game of life. Take notice and take action. If it's us or somebody else, do something. But don't sit by and just watch it all collapse in front of you. Bye.